All right, we are now live, Mike. Like I said, in about 4 minutes, I'll go ahead and start with that introduction for you.
Sounds good.
All right, thank you. All right, good afternoon and welcome, everybody. Today, I'm very pleased to introduce Mike Turner, President and Chief Portfolio Manager of Turner Capital Investments, LLC. He has a strong financial, mathematical, computer science, and engineering background. He takes a disciplined, rules-based approach to trading through the use of his unique directional investments. And with that, the floor is yours, Mike.
Thank you very much, Mark. Hello, folks. I'm delighted to be with you today, and I appreciate your time that you set aside to spend a little bit of your time with me. I take that very seriously. A little bit about me. You may or may not know who I am. A lot of folks who tune into these webinars have met me at various money show events and the like. But let me give you a little bit of background before I get into the presentation and where I am and what I would like to come across with you today, and hopefully open up the door a little bit to getting you to think a little bit differently than perhaps you have ever thought about investing in the stock market before. I know that you're a savvy investor. I know that you've got some money in the market. I know that you probably got, or at least you're thinking about it if you don't have money there, and you have enough knowledge about, enough experience about the market to be able to you've probably seen it all in your mind. You might say, well, I've seen all these technical systems, I've seen all these fundamental analysis systems, and maybe this guy Mike Turner is going to give me something new to think about, and I certainly want to do that. But the thing that I want to come across with you the most is that uh, you have probably spent the bulk of your adult life, investing life, certainly, in trying to be better at determining what's going to likely happen in the market or with a stock, or whether to buy now or to get out of it now, based on what you believe or what you research about or what you read about or what you hear about is going to likely happen in the future. The problem with that is that you don't know. I don't know. Nobody knows what's going to happen in the market going forward. And you're going to say, yeah, Mike, we all know that. Okay. Well, here's the thing. I have developed a methodology that absolutely does not depend on what the market's going to do. And it does really well. It makes a lot of money, a lot more than guessing about what the market's going to do. It does pretty much what you want to have something do, allow you to buy low and sell high, right? I mean, that is what everybody wants in the market. Whether you're buying a stock, whether you're buying an index, whatever it might be, really at the end of the day, you want to buy low and sell high, and you don't want to lose a lot of money along the way. And you want to be able to use the market over time and to be able to achieve growth in your holdings based on how that investment grows over time. Everybody wants to do that. Well, my background, if you don't know already, I'm an engineer by background. Engineers are problem solvers, and that's what I am. I'm also very heavily trained in software systems development. And so I've combined those two. And over the past 25 years, 30 years, I've been developing various systems that will improve my ability to invest money for my clients and myself with regard to the stock market. And about 5 years ago, I began to realize more and more that this stuff of trying to project, to take trends and estimate where those trends are going, how to be able to get into and out of the market based on historical movements of the market, and how a strategy would help you do a better job of getting in the market based on where you believe that the data are indicating. Everything is about the future. And almost everybody in the world works that way. One way or the other, they're all trying to figure out what happens in the future. I'm going to show you, and I hope you don't just kind of say, oh boy, I don't believe that. Please bear with me. But I'm going to show you how to make a lot of money and never have to worry about what the market's going to do tomorrow. I mean, right now the market's down, about a little less than 1%. And some of you are thinking, what's going to happen next? What's Trump going to do next? What's going to happen in Iran? What's going to happen in the Strait of Hormuz? And on and on and on. All these things that come into play. What's inflation going to do? What's the Fed going to do? On and on, trying to figure out what's going to happen. And sometimes you worry about that. Is inflation going to come along and push us into a bear market? Well, some people believe that's possible. Some believe it's not, but nobody knows. And the thing about it is if you could have an investment methodology, of which I'm going to show you, that does not depend on or use or even care about what the market's going to do in the future, and it does two things for you: grow your capital and keep you from losing a lot of capital. Okay. When you lose money, compounding goes away. You don't want to lose money. So if I can show you how to grow capital substantially in both bull and bear markets, and when you don't know which one it is, goes to cash where you can earn interest on that cash. So I'm going to show you how to do that. Stay with me. Don't give up on this concept. You're going to really be surprised about what it can do for you. All right, let's get started. All right, well, this is my team. Okay. The gentleman on my left is on the left you see on the screen is my grandson, young man, smart as you can get. The young lady on the right is my daughter. So it's a family firm, and we treat our clients as family. We've got over 30 years combined money management experience where we use rules, not opinions. Yes, I've got a really intelligent team. I think one of the smartest teams you can find anywhere. We don't guess about the future. It's all based on rules. We've developed these rules over time. It's kind of like engineering. If you're going to build a bridge, you can't go out there and just say, well, I don't know what kind of rules I'm going to use to build this bridge. You have to know what they are. You have to know what the formulas are. You have to know every piece of what's going to be used in that bridge to build a safe bridge. We do the same thing with the stock market. And we're focused on risk management. When we poll our clients, and we've got hundreds of them, and we say to them, what is important to you? They'll all say, well, I want to make money. Everybody wants to do that. And I say, what is your biggest worry about the stock market? And they say, we don't want to lose money. And I said, well, which is really more important to you when you really get down to it, the making money or losing money? And they all will almost always say, well, losing money is the they got to worry about the most. I like making money, but I don't want to lose money. And that's where we are. So we're really focused on risk management. So in the next 30 minutes, I'm going to explain to you why forecasting is a waste of time. It fails. Okay. And how our system, technical equity, works. Now, you're going to expect me to promote that, and I will, but it is a methodology. You don't have to use mine. You can take what I'm going to show you and walk you through and build your own system if you want to. It's not easy to build, but it is important for you to understand that forecasting, projecting, estimating, whatever you want to call it, and I don't care whether it's fundamentals or technicals or what it is, it does not work consistently. Yes, sometimes all of that forecasting will help you generate a profit and help you reduce risk. Sometimes it works, but not all the time. You know that. Have you ever put money in the market and lost on a trade? Ever? Of course you have. Everyone has. Okay. If you go with technical equity, is every trade going to work? No, they're not. Okay. Why? The market is unpredictable. The key is how to have more winning trades and larger winning trades than you have and have fewer losing trades and much smaller losing trades. That's what you want. That's what technical equity does. So I'm going to go through how this sets up against your objectives in your total investment objective you had for your money. Okay. So why forecasting is almost always not worth it. Okay. Forecasting relies on predicting what the market will do next. Do you know how easy it is to do that? Anybody can do that. But is it consistently accurate? It is not. I don't care who you are. I don't care what your name is. I don't care what institution you're at. I don't care how much, what size your PhDs are, whatever. I don't care. No one can accurately and consistently predict what the market will do next. They won't. They can't. It's impossible. Okay. Nobody can do it with accuracy and consistency. The academic research on this fact over decades and decades of time has proven that is the fact. Okay. So technical equity, that's our methodology. Entries are based on where the market is. You know where the market is right now. We trade 50-50 in the S&P and the NASDAQ. The S&P is down about 0.65% and the NASDAQ's about 1% down today. So we know where the market is. You do too. Okay. And exits. How do we get out? We get out when you've made enough money you don't want to lose. And we use trailing stops to do that. Getting in and how we get in is based on where the market is, how it got there, and how strong it is. Getting out is when we've made enough money and our clients are happy with that money. that if we hit a trailing stop, we're out. So the trailing stop is based on the fear level, the concern level, the worry level. In other words, for my clients, is how much can they lose when the market starts gyrating around and them not get overly concerned about it. The market's going to go up and down today. It's going to go up and down tomorrow. It's going to go up and down for the week. The question is, if we've made a lot of money, and we have, the current trade we're in, we've made a boatload of money for our clients. So they don't want to lose a lot. And we have an overbought condition. And when we get into that overbought condition, we have a standard trailing stop. When we're not overbought, we have a tighter, almost it's half of what the normal stop is when we get into an overbought condition. The market reached an overbought condition a couple of weeks ago that moved us into the tighter stop. Traditional market timers, and that's what most of them are, okay? They try to calculate when the future tops and bottoms will occur. They're all based on trying to make you think, or maybe you do this on your own, how you can determine when a top will occur or when a bottom will occur in the future. We don't do that. And so you're going to say to yourself, well, if you don't do that, how will you know when to get in? We get in after the market has bottomed. How do we measure that? When the trend starts going back up and we can determine that this was a low and now we've moved into the next trend moving up. We do the reverse of that in bear markets. So we get in after a bottom. And you might say, well, if you're going to do that, you're going to lose a lot of money. You're going to lose making that money anyway. No, you'd be surprised how quickly we can get in with this methodology after the market has bottomed. How do we get out? Well, we get out when the market starts gyrating enough that it triggers our trailing stop. Yes, we could have rules about when the trend changes and all of that, and that's all very doable. Same kind of approach we take for getting in, but we get out based on what our clients are happiest with, and that is preserving capital. Preserving capital is more important than saying, well, we have to wait until the trend is established. No, we wait until the trend is established to get in. We get out based on a stop loss, okay? So timing the market is nothing more than guessing, okay? We don't guess, we measure. So we trade the market, okay? Now you might say, well, why don't we trade NVIDIA, or why don't we trade gold, or why don't we trade whatever it is, okay? And this methodology will work for that. But my clients, and what I do is I trade the entire market. You know, the S&P 500 and the NASDAQ just about covers everything, all right? So the market is the two largest indexes in the world, S&P 500 and NASDAQ 100. The current market price, and this is important for you to understand, and most investors, most systems ignore this fact. It is the culmination of every decision made by every buyer and seller worldwide. It represents all the news, earnings, forecasts, economic data, political events, sentiment, and analysis of every buyer and seller in the world. At the end of the day, it doesn't matter what XYZ is doing on Wall Street with regarding all of the rooms full of analysts determining what's the best place to put money or take money out. It ends up in buying or selling shares. And that ends up in determining what the current market price is. So I can, you can, anybody can look at the current price of the market, and it has in it the culmination of all of that analysis in whatever the market is today, okay, the price. The result, knowing where the market is, the price, and how it got there, direction and strength, helps us identify when a market bottom has occurred or a top may have occurred, and thus the system instructs us to be in or out of the market. The only variation to that statement is that if in that process a stop is triggered, we get out then, okay? The bottom line, by focusing exclusively on the S&P 500 and the NASDAQ 100, I realize that's early on in my career, I didn't even want to think about buying the indexes. How boring is that? And I understand that. And I have found there is a ton of money that can be made there, particularly now that we've got leveraged index ETFs. Oh, when you begin trading the 2X and the 3X, and all my money personally is in the 3X. When you start trading the 2X and the 3X, the amount of money that you can make, yeah, the stops are going to be wider. You have to decide whether or not you can handle that kind of downside if it gets there, but the upside is so much greater that it's worth the risk, my opinion, for me. For each one of my clients, they can choose to be in 1X, 2X, or 3X, or a combination of them, okay? So our entire process is built on 3 market truths, and they're not market opinions. They're not theoretical. These are the actual market truths, okay? Not my opinion. Where the price is, where the market is. The price is a truth. It's when you look at the price of the market, it's not an estimate. It is what it is. And I don't care what it's going to be tomorrow or next week or at the next month, next year. I don't care. I'm making my clients money as it moves up. We go to cash when that trend begins to waver. We go into inverse index ETFs that move up when the market goes into a bear cycle and starts moving down. Okay. So the trend, how it got there, that's all historical data. The trend tells if the market is moving in one of 3 directions, up, flat, or down. That's it. And that's not based on projections. That's not based on hope. It's not based on how intelligent you are. It's based on how the market got to the price it is now. Was there a trend behind it? Was it flat? Was it up or was it down? That's all there is to that. Okay. And then momentum. How strong is it? Momentum tells how much conviction is behind the trend and how difficult it may be to reverse. So we measure that historically. We're not guessing about what the momentum will be tomorrow or next week or next month. We measure what the momentum is today based on how that trend moved up to today and where the market price is today. Think about that. Has nothing to do with tomorrow. Nothing. There's not a single thing we do based on what we think, and I know some of you think that's okay. It's okay to have that opinion. Good for you. But no one really knows what the market's going to do this afternoon or any other time. Okay? 3 truths, 1 process. Okay? A disciplined way. And we have to be disciplined. There's no, well, the rules say we should get in, but I don't know. Trump just did something in the Middle East that's got everybody in turmoil. Okay? So maybe we ought to wait a little bit. Nope, we don't care. We don't care what the opinions are. We don't care what the geopolitical issues are. We don't care about the economy. We don't care about what the Fed is going to do or any of that. We care about where the market is, how it got there, and the momentum behind it. That's all. That's all. Okay. So the market moves. The rules interpret those moves. So there's a trend. Is it going up or down or flat? Okay. There's the price. That's the position. There's the momentum. How strong is the trend? All that equals a set of information that the rules interpret, and it results in a buy or a sell or an exit. You notice it doesn't say short. Why doesn't it say short? Because in a bear market, don't you want to be short the market? No, you don't. There's nothing wrong with being short. There's just more risk in it because you can lose more than you might want. So we don't go short. We are in positions that go up. These are inverses that go up when the market goes down. Okay. So no forecast, no opinions, no guesswork. So here you got bull, bear. You're all invested, aligned with a bull trend. That's what our system does. You're all invested in inverse of the bear market with the trend and momentum coincides. Okay. So in both cases, we're all in and long. We're all in and long in a bull market. We're all in and long in a bear market, but in inverse index ETFs. And when we don't have either one, we go to cash, put it in interest bearing accounts. Okay. So is technical equity right for you? Well, you probably don't know, right? I'm telling you things that you may not believe, and you may need to talk to us about it. Talk to me about it. I would be delighted to talk to you about this whole concept. I mean, think about this. Wouldn't it be great to not get up of a morning and rush over and turn on CNBC to see what the market's doing? Wouldn't that be great? Nothing against CNBC. There's no reason to worry about or think about or base decisions about your investments, at least if those investments are technical equity strategies, with our methodology. So there's one strategy we call it the 1X. Its objective is to capture upside while managing risk. What does that mean? Market's going up, comes back down, goes up, comes back down. That's what the market does. We get in when it's going up. When it goes down, we go to cash. When it goes down more than that, we go into inverses. But it has the lowest return, still beats the market. Lowest return of our three strategies, best for lower risk tolerance. If you just say to yourself, oh, I don't want to lose anything. I want to have the lowest downside risk drawdown possible. And that'd be 1X. Expected result, participate in upside with lower volatility. And you're actually going to participate in upside and downside because we go into inverses in the 1X too. You can double that. Now, it's not exactly double, but we go into 2X index ETFs. It enhances return while maintaining a disciplined risk management. It's best for moderate to higher risk tolerance, meaning you can handle a little bit more. Over on the 1X, the largest stop loss we have over there is 7%. When we move into an overbought condition or oversold condition, that moves to half of that, 3.5%. That's where we are now, 3.5%. Nowhere close to that triggering, but that's where we get out over there. On the 2X, going to be double that. Instead of 3.5%, it's going to be 7% in a overbought where we are. It's best for moderate to higher risk. Oh, and you might say, well, I don't want 7. That's too much. Well, if we move it to 5 or 4 or 3, and in an undefined market or ill-defined market, you're going to get whipsawed to death. Whipsawing is the anathema of any strategy. I don't care what it is. If you set your stops too tight, you're going to get your butt kicked in volatility. So expected result is amplified participation. That's a techno jargon way of saying you're going to make nearly twice the amount of money in the 2X model than you do in the 1X model. Yes, you're going to have twice the drawdown, but when you're compounding and you put that money to work and you're making twice the amount of money of the 1X, that compounding actually reduces over time what that downside drawdown is net. So you want to always, my opinion, you want to look at upside gain versus downside risk. And the upside gain is way more than 2X over 1X, okay? Then we've got triple, 3X. Again, this is where I am. Why? And I'm going to show you some of that in a minute. It just makes a lot of money, and you want to be able to take advantage of that, okay? So be prepared for any market. No one can consistently and accurately predict what the market's going to do next, okay? Our rules are designed to account for the state of the market, advancing, declining, or transitioning. Our system does not need to scramble when conditions change. It reacts to where the market is, how it got there, how strong it is, okay? The current trend and strength of the market will continue until sufficiently acted upon by an unpredictable market condition. We're ready for that. When that happens, we get out, okay? So here's the most recent 3 years. I'm going to go through this rather quickly because we're running out of time. But here's the last 3 years. The black line is what the market, and the market in this case is a 50-50 mix of the S&P and the NASDAQ. The green shaded areas are when we're in the market. Oh, by the way, we're only in about 2 trades a year. Okay. And everything I'm showing you is net of fees. So the white bars you see, vertical white bars, when we're in cash and making money there. So all those other lines are trend lines. So over the past 36 years, I go back to 1990 in my data that I test this all on. And by the way, I don't use historical data to pick the rules. I build the rules based on what clients want to have happen: buy low, sell high. And then I run that against the historical data that's out there, historical market, in an efficacy approach to testing the methodology. So in the 1X, the S&P 500, if you buy and hold, was up about 8.8%. The 1X was up nearly 14%. And look at the compound annual growth rate. The CAGR for 1X is 11,000%. The CAGR for S&P 500 is only 2,000. So this is roughly 5 times greater. Okay, the 2X, look at that, almost 20% CAGR, and total return of 67,000% compared to 2,000 for the S&P. 3X is astronomical, 311,000%. And again, these are all hypothetical. I've only been using this methodology the last 3 years, but this is hypothetical when I take the rules today and go back and test them on the market over time. Okay. So if what you've heard resonates to you, schedule a call with us. I'm going to give you how to contact us here in a minute. We'll review your plan. We'll explore options. We'll align and move forward depending on what you want to do. No pressure. It's just a conversation. Okay. So thank you for your time. The opening account size has to be at least 50,000. Money is held at Schwab and individually managed account. And there's the contact to us right there on the screen. So feel free to get in touch with us. And these are the disclosures. You've read that. So Mark, do we have any questions?
Yes, actually we do. Wonderful presentation, by the way, Mike.
Thank you.
The question that we had was, help me understand your process, how your process is different than traditional market timers who also use mathematical probabilities delivered from data into guess.
Okay,
as you call it.
yeah, the big difference there is in the question that you asked. You had the right words to say. There's no probability in this. There's no projecting in this. Market timers try to figure out what's going to happen. We don't. We measure where the market is, how it got there, and we put our money to work under the assumption that the trend, if it's a strong trend, it will continue on that trend. That's the only assumption that we make. There's no trade timers, and we get incorrectly identified as a trade timer. Trade timers have gone back to historical data and built rules that will do well in historical data. That's just curve fitting. Anybody can do that. You're going to look like you're worth $1 bazillion because you've written code that maximizes historical data. We don't do that. Past performance does not equal future return. Everything we do is based on the 3 things I just talked about: where the market is. Trade timers don't use that. How it got there. Trade timers will sometimes use that a little bit, but they go back and use historical data and historical trends and historical patterns. We don't do that. And then the strength of the market. Some of them will have a little bit of strength of the market, but they really aren't worrying about that. They're worrying about what the strength of the market will be in the future. It's all about the future, the future, the future. So trade timers are trying to tell you what's going to happen next. We don't. We tell you where the market is, how it got there, the strength of the market now, and we put the money to work accordingly and look at the results that we're getting. Next question.
Yes, we have time for one more question. Over the past 3 years, what was your most significant evolution in your approach that brought you to such improved results?
Oh boy, that's this screen right here. I would have to say that's a great question. And I would love to be able to talk to you in more detail if we don't have the time to do it. But basically, it is this. about 3 years ago, actually 4, when I began to start building this, I didn't have artificial intelligence at my disposal. I actually didn't get AI to come to mature enough to be useful any earlier than last a year ago, this February. So about a year and a couple of months. And AI really didn't get useful until June, July of last year. So AI brought more to the table in the last year than everything I have done for the past 25 years, and particularly in the last 3 years. So AI was the big difference, and not so much that it would come up with new ways to do things as it did in being able to take an idea and extrapolate on that idea and then to test it immediately. Times in the past when I would want to test an idea about how we pick a stop loss or whatever it may be, it might take 3 or 4 months of traditional programming to get there. Now it takes 3 or 4 minutes or less. So AI has made a huge difference. I mean, look at that screen I've got, the charts I've got on the screen right now. Notice the green and the red arrows. That's when we get in and get out. Notice how many trades we make a year. Actually, less than 2. And look at the returns that we're getting on the screen on the left. I mean, they're unbelievable. And I know that they are. And that's not trade timing at all. All right, Mark, I guess we're done. Thank you, folks. I appreciate all of your time and Money Show, and look forward to hearing from you. So give me a call or send me an email, and I'll be delighted to get back in touch.
Thanks again, Mike. Always a pleasure.